Get ready for the big revival. The real estate revival, that is. Now on 77 WABC, your New York weekend.
Get ready for the big revival.
It's Rand on Real Estate. Look out! With Greg Rand.
Welcome to the big real estate revival. This is Greg Rand. Glad you're with us here on 77 WABC and WABCRadio.com. I'm here with Laura Smith. How are you?
Always good to be here.
Great to have you. We have a great hour lined up for you here, as always. We're going to be talking about building wealth. Building wealth during the Great Recession. What a concept, huh? So we're going to focus on that. We're going to give you some tips and some pointers and some ideas about how to use real estate to accomplish that. I've got somebody terrific coming into the studio. He's a fellow Fox Business Network contributor, a money manager, an author, an all-around great guy. Dan Schaffer is going to join us in the next segment talking about how, well, I'm going to make you wait to find out, but he and I are on the same page with some of these things about how now is an extraordinary opportunity if you know how to play it right and if you have your head straight about what the opportunities are and how to time them. We're going to take your calls. So make sure you get this number down, 800-848-WABC. That's 800-848-9222. We want to hear from you. The best part of this show is when people from the listening audience call me, ask me questions. If you have ideas, let's hear about them. If you have fears, let's hear about those too. We want to bulletproof your plans because you're entering into the part of the economic cycle where the money's really made if you set your plans up right now. So call us, 848-WABC. I have a book called Crash Boom. We're going to talk a little bit about that throughout the show here. You can get Crash Boom at ownamerica.com. And that is the whole nature of our approach in this show, is that after the crash comes the boom. After the boom comes the crash. These things tend to repeat themselves. And that's one of the reasons why I have such unshakable faith about what's coming next. Because I understand history. I understand what part of the history we're in right now. And it's all good. It's all good if you have the fortitude and the ability to look past the pain and the anguish of right now. So that's the thing. You know, we talk here about building wealth, and in my book and in my courses, I talk about the 5 principles of building real estate wealth, the 5 principles. And I learned these principles from working with professional commercial real estate investors, the big dogs, the people who are quietly making hundreds of millions of dollars in the commercial real estate business. And I was able to work with them, watch the way they operate, kind of reverse engineer their intuitions. You know, they'll tell you that they work on gut instinct, but I was able to observe that gut instinct and then apply that to everyday people just like you and me who are going to buy small real estate investments, season them over a long period of time, and build generational wealth for our family. And we talk about the 5 principles. I can only kind of go into any one of them, Laura, in detail per show. So we're going to focus on principle number 1 today, which is number 1 for a reason. It is the precursor for all the rest, and that is timing is everything. Timing is everything. And when you think about where we are right now in this economic crisis, I want to use kind of a silly analogy, but one that I think really makes sense. And that is on New Year's Eve. All right. You know yourself. New Year's Eve, you may be a quiet person during the rest of the year, but like most people, you probably go out and go a little bit nuts on New Year's Eve, right? It happens all the time. Mm-hmm. Everyday people. Back in my hard charging days, we used to call that the junior varsity. We'd actually stay in and protest because the junior varsity was actually out on New Year's Eve, and they would clutter up the highways and clutter up all the bars, and we'd stay in just to make a point. But the idea here is that on New Year's Eve, people go out, they stay out too late. They hit the beer, they hit the wine, they hit the champagne, they hit the vodka, they hit the whiskey. They do exactly what they're not supposed to do. They mix everything. They stay out till 4 o'clock in the morning, and the next morning you know what's going on. They wake up late. They feel horrible. Right? I know, Laura, you've never been there, but you must have heard about this kind of stuff.
No, never. And I don't know anything about football, so there you go.
The idea that the next morning, the hangover the next morning, is a very interesting analogy to where we are right now. Because if you look at what happened over what we call here the roaring 2000s, right? 2002, an economic boom began, and it went haywire, all right? The real estate market was booming. The stock market was booming. People were making money hand over fist. But then human nature took over. And people do what people do. They always seem to repeat the same mistake. People watch other people making money, and they say, hey, that looks easy. I want to get in on that. And so they start speculating. They start going in and looking at stocks, and they're amateurs, but they're going to dump their money into it. They start looking at real estate, and they're amateurs, but they jump into it. And then the banks play their role. And the bank's role is always to begin to lend money without thinking, lend money by lowering their standards, pouring capital out into the market. That's the party. That's New Year's Eve, okay? And this was one heck of a New Year's Eve. You know, some are better than others, and this one, the Roaring 2000s, was a crazy waiting till the daybreak kind of party, and everybody woke up the next day with a hangover. But here's the thing. January 1st comes, you feel lousy. January 2nd comes, and if it was a big party, you're probably still feeling a little bit of it. But what about January 3rd or January 4th, right? And certainly by January 7th, it's all over, right? I mean, no matter how big of a rager you had on New Year's Eve, you're feeling okay by the time a week goes by. I think where we are right now is right around January 3rd. Okay? We're still feeling the effects. It was a big party. We're still feeling some of the effects, but the dust is starting to clear, right? Your head is starting to clear. You're starting to be able to see that despite the media drumbeat of negativity, despite the fact that every time we turn around, it's somebody else coming out with more reason to be afraid, more reason to not have job security, even though you might, more reason not to take a risk. You're looking at it now and you're saying, hey, you know, I can start to feel like maybe some momentum is coming back into this economy. Maybe my fear is unfounded. Maybe it's time to start taking action. And that's where we are right now, January 3rd. The emerging boom that you're going to see happening, which probably won't happen for a couple of years, begins with the earliest adopters, the people who have the guts, who are looking for that dust to clear, to feel like it's safe to jump back in the water again. You know, the shark has just barely gotten over the horizon, and they're jumping back in. Now, I spent some time this week in Las Vegas again, because the Las Vegas real estate market, talk about the hangover analogy, that place went absolutely haywire during the Roaring 2000s. And right now, guess what? More than half of the sales happening in Las Vegas are not just investors, but all cash investors. I spoke to some people who came out of Wall Street who are going to Las Vegas with private equity money. Their job usually is to use these funds to go find a distressed company, a company that needs help, a company they can buy at a discount and then improve and then make a killing on. They're looking at Las Vegas as a distressed city. Literally an American city in distress. We've talked about Vegas here because, you know, people understand that city. It's kind of an internationally renowned city, but you know that it's a gambler's paradise by definition, and that was the same way in the real estate market. But there are people out there now that are looking to spend tens of millions of dollars to acquire pieces of that market. Same thing's happening in Southern California. Same thing is happening in South Florida. Same thing is happening in Arizona. And my point is this. While consumers are looking for a reason to stop being afraid, right? They won't spend their money, Laura, until they're not afraid anymore. They're going to keep saving, keep it close to the vest until the fear dissipates. But the investors, they're looking for an opportunity to pounce on something. So they're always the early adopters. They're always the ones that when you see them darting left, the whole herd is going right, and some people start darting left. If those are investors putting cash down, those are people who see a horizon much closer than the rest of us. And so we watch their action, and we know that they're the kind of people that we want to follow down the path.
Isn't that easier for someone, though, who has a lot of cash and capital that they can invest? I mean, the average person on Main Street maybe doesn't have that kind of money to go in and do right now. What do you say to those people?
Well, it's true that it takes money to make money in real estate. And I'm not suggesting that we should all run down to Vegas and start buying properties with cash. What I'm trying to paint the picture for here is that until you have faith in your heart that the American housing market has gone through a temporary, isolated situation. I mean, isolated, okay? It's very explainable what happened in the last couple of years, and it's directly related to what happened the couple of years prior to that. So when you start to see other people, you know, follow the money. When other people are jumping in, that should give you a little bit of confidence that they see something that maybe validates your own personal point of view. So point is that we're there. We're at the point right now where you're still buying low. Now, next year, the year after, you're still buying low, but you're buying before the masses begin to clog up the works again, before the everyday people who are speculating, trying to add no value, just trying to get rich quick and get rich easy, before they mess it up, that's when you want to jump in. So think about giving us a call, 800-848-WABC. You're listening to Randon Real Estate on 77 WABC. Back in a moment. All right, welcome back to Randon Real Estate. This is Greg Rand, your host on 77 WABC. The phones are lighting up over here. We want you guys to stay on hold because in a moment we're going to be talking to Dan Schaffer, a money manager, a CPA, a Fox Business News contributor, and an author of a fascinating book, Profiting in Economic Storms. We have to get to Dan quickly because he's got his limo double parked outside. He's a real big shot. We want to make sure we don't keep him waiting and have him storm out of here or anything. But I had to take Fred from upstate New York. Fred, thinking about buying a condo, are you?
Yes, we are. Yeah.
So tell me about that.
Well, what we've done is we have a second home down in the vicinity of the Myrtle Beach area. So we've looked at the Myrtle Beach area condominium market, and we found a place on a short sale basis. We actually went to contract with it. Funny thing happened today, though, is we got notified from the realtor that the bank fired the short sale company that they had hired, so they're looking for an extension from us for another 40 days before we close. But, in looking at it, we're trying to assess whether we're making the right move or not at this point.
Well, by quick background, in case people listening don't know what a short sale is, a short sale is the owner of this particular condo owes more money on the condo than the condo is worth. And so in order to sell it, they have to get the bank to approve it. So let's say, give me a number. What's the offer on the condo, if you don't mind sharing those kind of details?
$200,000.
$200,000. So they have a mortgage balance of something above $200,000, which means the bank.
Right.
Yeah, what, $250 or something?
Well, no, these were originally they were built in 2006. They were going for $480 and change.
Ooh, okay. So someone owes a lot of money, and therefore the bank has to approve a short sale because they're walking away from the closing getting a lot less than they are due. And what happens there is that someone like Fred and his wife, they make an offer, and they have to wait for the bank to make a decision. And in this case, it appears the bank made a decision and now wants more time to sort of think it over. A couple of things, Fred. One, this is a condo that you're going to rent out seasonally, rent out annually. What's the plan?
The plan is it's one of these resort area condominiums, multi-unit condominiums, and so it's an oceanfront operation with like the indoor wading river, pool, and things like that. So the idea is to buy it, and obviously there's a management agent on site who rents the unit for you. And
so you're going to go down there on vacation, though, right?
No, we're not. We have a vacation home very close by. So that's,
okay, I mixed that up. Okay, so you already that's great news because if you can find somebody who's going to hold that place or going to be able to lease that place for a year at a time, that's one of the questions I would want to ask the rental agent because when you have a rental agent who's going to try to rent it out a week at a time during the hot season, Myrtle Beach is one of those places where the season is only really just before Labor Day to just before Memorial Day to just after Labor Day, and so you don't get the Florida season. And they take a big commission usually to do that renting. And so one of the questions I would ask is, can you find somebody who lives down there full time who's going to want to occupy that place year over year? Since you don't need to use it, having a full-time tenant that you pay a commission once a year and then they occupy the place the whole time keeps you collecting rent during all those winter months.
Makes sense.
Is that a possibility? Have you asked that question yet?
We haven't, but that's a good thought because what they do rent these things on a weekly basis, and we know what the annual income on it. It's not a big number, but it's something that looks like it would carry certainly the POA and the part of the mortgage anyway.
All right. Well, here's the idea: is when you're talking about a second home, you can tolerate not being able to carry the costs. Okay, but if it's an investment. The fact that you go down there is great, but you might, now that they've given you some time, okay, they're making a mistake because you were on the hook and now they're saying, keep nibbling the hook. We're going to give you some time to think about it. See what you might be able to find inland by a little ways, all right? Because inland, chances are obviously the costs are going to be lower. The likelihood of being able to rent that out seasonally, or not seasonally, but annually is going to be greater. And since what you're doing there is placing bets in a market that you trust, because you already have a second home there and you may wind up retiring down there, and what you're doing is building up resources in a community you may wind up ending up in, use the time wisely to snoop around a little bit, see if maybe you can use your money to buy 2 properties that are 5 miles inland from the waterfront. If the demand is there because there's a good workforce down there, that might be a better use of the dollars. That way you can be sure you can keep it occupied and rent flowing in every month year-round.
Right. Makes sense.
All right, Fred, thank you for the call. I love the Carolinas. I love your timing. So one way or the other, you should go forward with something.
All right, very good. Thank you.
Okay, thank you. Everybody else is on the phone. Stick around because you're going to want to hear what I'm going to talk about next. We've got Dan Schaffer here. He's a money manager and a CPA. He's a Fox Business contributor. He's the author of the fascinating book, Profiting in Economic Storms, which if you know anything about me, you know that I'm a big believer in profiting on economic storms. So how you doing?
Good to see you. Thanks for having me on.
Thank you so much for being here. So you've heard the shtick so far. You understand what this show is about. What is your general opinion about where we are right now in the economic cycle?
Well, my book talks about this, and right now we're on the downside of the cycle, and what people need to realize is that they'll never get the bottom and you'll never get the top. So right now, the opportunities that we're seeing today going into 2011, 2012, are probably going to be the best opportunities in real estate that we've seen in 40 years, even better than the 1991 cycle, the 1987 cycles. And history repeats itself. And if people don't seize this opportunity, they're going to miss it. And the one reason I say that, and I've been in this business since 1982, and I have never really been involved in the real estate market for my clients until now. This is the first time in my whole career, and I'm introducing my clients to it through a non-traded public REITs, which are real estate investment trusts that are building up cash now. They have no legacy assets, and it's a great way to participate in the commercial real estate market. And the reason I say this is because there are these balloon loans. You're familiar when these commercial properties, they 7-8 years ago, they take out these loans. They pay the interest only, and then now they've got to pay the money back. The problem is the banking system can't support all those loans that are out there, especially with the properties that are underwater.
Right. Let me give you some background to the listeners on that, because he's absolutely right. There's a really, really interesting commercial real estate trend that has been percolating that everyday people can't take advantage of because it's tens or dozens or even hundreds of millions of dollars to be able to acquire one of these properties. But what happened was this. Historically, commercial real estate, you could only borrow 60 to 65% of the value of the property. The traditional sources, the banks, would say if you have a $100 million building, we'll give you 60 to 65 million on a loan, but you have to come up with the rest of it as a down payment. And you can never refinance more than that amount. But then during the roaring 2000s, hedge funds, private equity funds, non-traditional sources of lending entered the commercial real estate space in droves. And what they did is said, hey, we'll give you 80%. So your building's worth $100 million. We'll give you $80 million. That owner took that money, took the $20 million difference that from what he used to owe to what now he owes, put it in his pocket, reinvested it, spent it, did whatever. But those loans had 5-year ticking time bombs attached to them. They had balloon payments, which meant you had to refinance that loan in 5 years. You had no choice. You had to go back to the source of funds and say, I want a new loan, give me a new rate, and requalify for it. But two things happened since then. One, the values came down. So that $100 million building is now worth 80 or less. But also all those sources of funds, the hedge funds, they exited the business. So the only people left are willing to give you 60%. So 60% of the value of the $80 million property leaves that owner of a great building with potentially great tenants, fully occupied, paying a profit, but they're going to lose the building to bankruptcy because they cannot come up with the financing to pay off the hedge fund.
Right. Right. And the cap rates are very important to try to maintain them. And that's you don't have the leverage anymore that you had 7-8 years ago.
So what REITs are doing, they're compiling their resources right now, and they're going to be attacked. They're piling up the resources right now so they can attack that situation, get people out of the trouble, buy a distressed building, but it's not distressed by all the classic definitions because it's probably a Class A office building, fully occupied, working like a charm, but because of that one circumstance, it's underwater right now.
Right, and the biggest issue, though, is that the REITs, these real estate investment trusts, are going to replace the banks. It's what I consider it the shadow banking system.
Okay.
The banks are not going to lend the money the way they used to, so the REITs now are accumulating cash, buying from investors, and going out and looking at these properties one at a time and doing private deals to just take them off the hands of the sellers who can't hold them anymore because of the balloons coming in. And they have wonderful returns. Like you said, fully occupied, great cap rates, solid AAA buildings, and they're usually, triple net leases, which means that you just own them and the tenant takes care of all the property. It's a really great deal. So that's just one aspect.
What's interesting about that also is that, one of the things that we know, I advocate individuals buying individual properties, getting the deed, managing the property, being an entrepreneur. But a lot of people say, that's great, Greg, but I do not want to be a landlord. No matter how much you tell me I should be, I don't want to be a landlord. And one of the ways to play the real estate market without having to touch the property is with these REITs.
Right. And part of the cycle here is that we're going down in the cycle. So you're going to be buying properties cheap. And then the hyperinflation environment that everybody's predicting, if you look at the price of gold and all the newspapers, these properties are going to appreciate tremendously. So while you're getting income from the property, you have a potential capital gain down the road. And we're only talking 3, 4, 5 years that these properties can appreciate from here.
This is great stuff. We're going to go to break. Hang on after the break. We're talking to Dan Schaffer, money manager, CPA, author of Profiting in Economic Storms. You're listening to Randon Real Estate on 77 WABC. Back in a moment. Welcome back to Randon Real Estate. I'm Greg Rand, your host on 77 WABC, broadcasting from the Small Business Authority studio. Our number here is 800-848-WABC. That's 800-848-WABC. 9222. My website is ownamerica.com because you can own a piece of America. It's the best investment anybody ever made. And we're here with Dan Schaffer, and we're going to go back to him in a second because I want him to hang around the studio. We got some calls holding. I don't want to leave you guys waiting too long. So, Tony from the Bronx. How are you, Tony?
Hello?
Hello, how are you?
Yes, good. I've been looking to buy commercial property now for about 3-4 months in the Bronx. And, I don't see anything that's really come down in price.
Now, what kind of commercial property are you thinking about? Office space, retail space? What do you have in mind?
Actually, warehouse space. We're looking for about 20,000 square feet. And I've been finding that prices have kind of stayed where they've been for the past couple of years. Yeah,
it's interesting. Warehouse of all things. Warehouses, they're fairly abundant, but when you're talking about inside the circle of the metro area, when you can get into New York that easily, they become pretty much of a premium. Now, are you going to use the property in your business, Tony?
Yes, I'm going to be using it for my business, about half the building, about 10,000 square feet, and I'm looking to rent out the rest.
That's a great plan, by the way. That's like a two-family house, right? You live in one half and you rent out the other. I like the plan. If you've been looking for a couple of months, you want to stay near the Bronx, all right? You don't want to go out to the other boroughs or go into Lower Westchester, Yonkers, something like that?
No, because I need easy on, easy off for Harlem, Queens. We have stores in the Bronx where we repair consumer electronics. Okay, and we're looking to open up more stores in Harlem and in Queens.
Yeah, so I think that
finding that 20,000 square feet is almost $2 million.
Yeah, it's interesting you say that. I ran a commercial real estate company up in the suburbs for a lot of years, and we crossed over into the boroughs a little bit. And warehouses that you would think, warehouses are the lowest price per square foot that you could rent out, right? They're the lowest use, okay? They're the lowest use, and you're talking about Manhattan or the five boroughs. Keep searching around. I think if you kept looking in another 3 or 4 months from now, you found that was basically the thing, is that the supply of warehouses of that size in your area are just limited enough that you're not going to be able to do it any cheaper than that. The market's speaking to you. Your plan is great because being able to occupy it, you do that for your business, and then you just blink your eyes, and 10 years goes by, and now you've built so much equity in the place, and the person renting out the other half is paying it off for you. If the marketplace is commanding a premium, there's a reason for that. And if you were going to rent it out completely, I would tell you to rethink it and maybe go elsewhere. But if you're going to use it, it's so much better to be able to own the building that you operate your business out of because you're going to be there. I mean, how long have you been in business so far? You've been in business a long time?
We've been in business for almost 15 years now. Okay,
and you don't expect this to be a short-term thing, right?
No, I mean, everybody, people can't buy these new iPhones anymore, so we fix them. That's what we do.
Brilliant. I love stories like that. People, they break their iPhones and you guys repair them. Well, I'll tell you what, so keep looking, keep scratching. Do you have a broker who's doing a lot of bird dogging for you, really working hard for you?
Not. Well, we did have one guy, but he really can't find anything for us.
All right, do me a favor. If you're interested in having somebody else go do some scouting for you, before we're done, give your phone number to the call screener, and I'll get somebody in touch with you if you're interested, because commercial brokers are junkyard dogs, man. In a situation like this, they start banging on doors. People who didn't know they wanted to sell, all of a sudden find out somebody's buying, and you turn something up that nobody else even knew about. That's the way to go about it.
Okay, good.
All right. Thanks, Tony, for the call. Thank you very much. Anybody else on hold, just stick around. We're going to get to you in a moment, but we're going to go back over to Dan Schaffer, CPA, non-practicing CPA, money manager, Fox Business regular guest there. Actually, you're going to be co-hosting a show on April 1st from 12 to 1, which is a big jump forward. Congratulations on that.
Thank you.
He's got a face for TV. I got a face for radio.
Not true. Kinds, not true, Greg, at all.
Takes all kinds. So we talked about real estate. Now let's talk about cycles. I was fascinated in your book, Profiting from Economic Storms, because in my book, I went back to the 1980s, the 1970s, and the Great Depression. You went back further. And what you found is that...
A lot further.
A lot. So tell us some of those historical situations.
Well, I mean, I've even gone back to the ancient Egyptians, ancient Roman Empire, and the ancient Greeks, but just over the several hundred years of the United States history. And people need to realize that the United States is not an old country. We've only been around 250, 300 years. Right. But back in the 1812, 1816 period, there was the Napoleonic Wars, which destroyed agricultural land in Europe, and land started to boom here in the United States, and the banks went crazy, just like they did here in 2004, 5, and 6. And they were lending money to everybody, and they leveraged up, and property values tripled. And there was the big panic of 1819. Back then, the banking system, it was the second bank of America, of the United States. They were allowed to call loans. So if you owned property and the bank knocked on your door, they say, we want our money back. You had to give them their money back. So property values plummeted. And that is really, in historical terms, considered the first real estate panic in the United States.
So the banks lent money like crazy and then started calling it back like crazy and caused the crash.
Right. Now, does that sound familiar a little bit here?
Yeah.
History repeating itself? Exactly. That's exactly what's happened. And it's happened multiple times since then. And then there are these other cycles that take place. There's the 40-year cycle. There's a 70-year cycle. There's a 35-year cycle. And that cycle that we follow, which is a 40-year cycle, is due right here for a market low. And we're not just the stock market low, but a real estate market low, because over the last 10 to 15 years, mostly all asset classes rose at the same time.
Right.
Treasuries rose, stock market rose, real estate rose, everything rose. So now you have them also working together, that they're all declining at the same time. And the issue with the dollar getting weaker, which I believe is going to get stronger, people are going to start selling more assets to raise cash. Commercial real estate, we've already seen the housing market real estate, but commercial real estate, your caller, Tony, just be patient, because the properties will all of a sudden start to show up, and you need to be ready.
So your point is that we're still approaching an overall economic low, and when people have a demand for cash, they start unloading assets for whatever they can get them for.
Exactly. Cash is going to be king. If we realize this, I'm on the opposite side of this conversation about a weakening dollar. That's a political issue, and I don't want to get into that with this show. But as debt defaults all over the world in U.S. dollars, there's actually a shortage of dollars. So people who even still own hard assets and real estate are still going to need money. And they will start selling properties. I know properties here in Manhattan. A gentleman owned 5 properties. He had a balloon loan on one of them, and he had to sell his gem property just to cover the properties that were not as good. And it was a really great opportunity for one of the REITs to take advantage of. So, you got to be ready for the cycle. We're in that cycle now. We're coming into the low. Don't try to pick the bottom. You'll miss it. You can never pick the bottom, never pick the top. If you get 80% of the move, you're in good shape.
I'm glad you mentioned that, because I've made a career of studying successful real estate investors. And what I found is that they never try to time it perfectly. Okay, they never try to. If, the people that I know who are really wealthy with real estate investing, they were unloading in 04 and 05. They were getting out of the market back then. And the signals they saw were the speculators, the spoilers, the people that come running into a market, don't have the skills, don't have the know-how, have banks behind them giving them more money than they should. And that causes those guys, it's the old saying from Warren Buffett, right? When others getting greedy, I get fearful. So those guys pulled out, you would think, early, because they missed like 2 or 3 years of nice solid appreciation, but
Absolutely.
They don't care, because guess what? They come back around now.
Right.
And your point of the 40-year cycle is that we have not yet seen the best opportunities yet.
That's
the next
correct.
few years, how many years do you think before the opportunity
I think that window is going to close based on I'm a technician, technical analysis and cycles. So I'm looking at 2013 to possibly be the extreme low. But, just going back to your point, Sam Zell, he sold out a whole empire of real estate, not catching the top, but he caught it now. If he was going to do it now, it would be a problem for him. And people need to know that these cycles exist. And, the goal is to make sure you've covered the costs of the property and that you can withstand a little bit more of an economic downturn before it turns. Because when it turns, you're not going to be able to get there because everybody else is going to be chasing it.
Right. Well, that's the key. All right. Good. Stick around. This is Rand on Real Estate, 77 WABC. If you're on the phone, stick around. We're going to get to you as soon as we get back for the break. Our number here is 800-848-WABC. Back in just a moment. Welcome back to Rand on Real Estate. My name is Greg Rand. I'm your host. This is 77 WABC. Also available on WABCRadio.com. We're broadcasting from the Small Business Authority studio. My website is owenamerica.com. You can get a copy of my book, Crash Boom, if you want to get your faith back. If you want to realize that after every boom comes a crash and every crash comes a boom. And guess where we are right now? We're after the crash. So we've got some good stuff coming to us. We're here with Dan Schaffer, who is a contributor to TheStreet.com, author of a great book called Profiting in Economic Storms. We're going to get back to Dan in 2 seconds because I want to take a call from Larry from New Hope, Pennsylvania. How you doing, Larry?
Hi, how you doing, guys?
Thanks for hanging on so long. So what's your question?
I bought a house in '05. It's basically a starter house in New Hope, Pennsylvania. It's about 20 miles west of Princeton. I'm looking to upgrade. I bought pretty much at the top, but I sold at the top from my other house. Okay. And I'm figuring if I go into another 1,500 square foot, it brings me into that medium market home. Right. What do you think the upside, 3 to 4 years, would be down the road?
That's a great question. I think,
as an investment.
I think the upside 3 to 4 years is going to be probably fairly flat. That's the bad news. We're going to be coming down, I think, a little bit between now and a year from now. But I expect that what generally seems to happen after one of these tumultuous times that we're going through right now is that the market stabilizes and it just takes a deep breath. It quiets down. And so I wouldn't expect to see much in the way of a big equity buildup, a big appreciation between now and 5 years from now. I think it's going to be the next 5-year period where it's going to come from. And so my question for you is, if you bought near the peak, do you have equity in the house that you're in right now, Larry?
Yeah, I have about $350,000 in equity in a house that I could sell for about $550,000.
Okay, and so
I'm looking about taking on in monthly bills between taxes, utilities, and payment another $2,000 a month.
That's in addition to what you're paying right now?
Yeah, in addition to what I'm paying now. My mortgage is lower with taxes. It's about $1,200 a month.
Okay, well, you know what? You're the only one who really knows whether you want to be able to swallow that increase in payments. The advice that I would give is that when you look forward and you see, do you have a 30-year mortgage right now?
Yes, I do.
All right. What I'd like to see you do is, if you've got 25 years left on that, when you do your analysis of what you're going to buy next, do it based upon a 25-year payment. You can go out there on the web. You can find places. You can change the 30-year term to a 25-year term. Put that sort of flag on the hill that I'm going to have this thing paid off at a certain date in the future. And if I upgrade because it's going to be better for my lifestyle, I'm going to enjoy my life more because I have a bigger house. Do that, because life's about having fun, right? But don't keep extending out the 30 years, because every time you upgrade, if you throw away that 5 years that you just put in, eventually you're going to regret that. So do the analysis based upon, if you're going to be spending an extra $2,000 a month, it may be more like $2,300 or $2,400 a month if you made that shorter term payment. But that'll sort of give you that peace of mind to know that you upgraded. You're neutral because you're selling and you're buying. So if you do that all within the same several month period, you're going to take a little bit of a beating on the sale, but you're going to deliver that same kind of beating to somebody else on the buy. So you're neutral there. But amortize your house. Pay this thing down over time. Does that make sense, Larry?
I got one more question. As far as, do you think we're pretty much at like 1996 levels after we came off that bottom in 91? And kind of how that market was stagnant for like that 5 years. And
no, I think we're like 1990 right now, and even 1989. We haven't finished correcting yet, and we're going to see 5 years of a flat line, and then we'll be at 1996. So thank you, Larry, so much for the call. I hope that you have success with your endeavor. And we've got Sharon from New Jersey. How are you, Sharon?
Hi, how are you?
Terrific. Thanks for calling.
Yes, you're welcome. Okay, my question is, you had mentioned that South Florida is one of the places to buy for investment.
Right.
Are you suggesting inland or only on the water, and does it make any difference whether it's the east or the west coast, and how far south?
Okay, great questions. If your purpose is for long-term nest egg building, right, if that's your objective, is that what you're doing, or are you going to go out and use it as a vacation place?
I'm not sure. Whatever is most lucrative. I'd love to use it as a vacation place also, but I'm not sure if that's the way to go.
That's a different business plan. If you're going to focus on it as an investment, I like the idea of going to West Coast or East Coast is personal preference. Okay, they're both getting beaten up right now, and they both have fabulous long-term prospects. But I like the idea of going in a few miles. Decide you're not going to use it. When you go on vacation, stay someplace else. You go inland by 5 or 6 miles on either Fort Myers, Naples, or Palm Beach and Boca Raton, and you see the values plummet from there. Not because of anything except for the fact that the further you get away from the beach, the more the prices come down, and your money will go so much further in terms of either being able to buy one luxury condo or 2 or 3 nice condos or townhouses or single-family homes, but not luxury. They're not there for vacationers. They're there for people who are going to live there year-round, pay your mortgage down for you. So when you head down there, think about your vacation is going to be on the beach, but your investment is going to be a few miles in. Okay, Sharon?
Okay. Thank you so much.
Thanks for the call. All right, we're getting close to the end of the show here, but I wanted to ask my friend Dan one more question. This is Dan Schaffer. He's a money manager. His company is at Schaffer Asset. That's SHAFFER. Asset.com. His book is called Profiting in Economic Storms. And you're a money manager, so you work with individuals to help secure their wealth long term, right?
Yes, I work with individuals to coordinate their assets and make sure they're in the right places based on their levels of risk.
And of the people that you're working with, where right now you mentioned earlier that the REITs are one of the places you're recommending. Do you ever recommend people go and buy individual properties, or is your sweet spot still securities and bonds and things like that?
Yeah, mostly mine are public securities and asset allocation, but I do incorporate those assets into their financial plan because those are real estate assets that are non-liquid. So I can advise them. I get questions about it a lot, but it's not something that I'm out there actively doing. I do mostly the security side.
And how often the people that you've got that are wealthy, that you're helping them manage that money, how often did they get there because of real estate investing over the long term?
You mean out of the clients that I have?
Out of the clients that you have, are the people who have already made it, is real estate one of their plays?
It's interesting. A lot of my clients are not in the real estate business because they're running companies. They're doing their own businesses. They come to me to manage their money.
Very interesting. All right, well, we're gonna spend some more time offline talking. We're gonna see if I can get you to get some of your clients to start putting some more money into real estate. But I want to tell you, Dan Schaffer, you've been a great guest. I'm so happy that you came. Again, his book is Profiting in Economic Storms, available everywhere. His website is SchaferAsset.com, and I really appreciate your perspective because we're kind of cut from the same cloth. You know, we do it in different ways. We operate in different sides of the equation, but we both believe that right now is such an extraordinary opportunity in historical terms that if people have the guts, get good advice, take the plunge now, and have a long-term view, they're going to do very well. So thanks for being with us.
Thank you for having me.
It's been great. Okay, you've been listening to Rand on Real Estate on 77 WABC. My website is ownamerica.com. I want you to own a piece of America.